Hi everyone, I'm Rachel. Welcome back to ChainSense. If you're new here, it's great to have you. On this channel, we make crypto simple. No hype, just clarity. Today, we're talking about something I wish I had known years ago. How to make your crypto work for you, without trading, charts, or sleepless nights. I earned about $800 in 6 months doing precisely that, and I'll show you how to start safely in 2025. Let's begin with the first and most reliable strategy. Crypto staking. Staking is like putting your crypto to work for the network itself. When you stake, you lock coins to help validate transactions on a blockchain. In return, you earn regular rewards, similar to interest from a savings account, but 5 to 10 times higher. The network stays secure, you earn yield. Everyone wins. The most established staking coins this year are Ethereum, Cardano, Solana, Polkadot, Cosmos, and Avalanche. Yields range between 4% and 15% annually, depending on the network and validator. Platforms like Lido, Kraken, and Rocket Pool made staking simple. Lido even introduced liquid staking. You stake ETH, get a token called StayETH, and can still trade or use it in DeFi while earning yield. That flexibility completely changed the game. And now we're seeing the next evolution, restaking. Protocols such as Eigenlayer or Carrick let you reuse already staked ETH to secure multiple systems and earn layered rewards. Essentially, your crypto gets paid twice for the same job. Let's compare it to traditional finance. A savings account might pay 1% interest. Even government bonds rarely reach 4%. Staking can deliver between 5 and 15%, all while helping the blockchain run. Of course, there are risks. Validator downtime, lockup periods, and market drops. However, if you choose reputable providers and diversify, staking remains one of the safest methods for generating yield. Now let's move to the second core strategy, crypto lending. Lending is when you deposit your assets on a platform that lends them out to verified borrowers. In return, you earn interest, usually paid daily or weekly. It's simple. You provide liquidity, and others pay to use it. Centralized platforms like Nexo, Binance Earn, and uHodler handle everything for you, from custody to insurance. DeFi options like Aave or Compound let you lend directly from your wallet. No middlemen, complete transparency on-chain. Average returns look like this. Bitcoin, 3 to 6%. Ethereum, 4 to 8%, and stablecoins, sometimes 12% per year. That's steady, predictable cash flow while keeping ownership of your crypto. But always remember, safety first. Spread funds across several platforms. Withdraw a test transaction first, and double-check their licenses and insurance coverage. The goal is passive income, not passive risk. Staking and lending together form the foundation of long-term crypto income. They're lower risk, beginner-friendly, and teach discipline. Once these are in place, you can explore more advanced strategies. In Part 2, we'll go beyond the basics, into yield farming and diversification, where returns grow higher, but so does the need for sound risk management. Educational content only, not financial advice. Hi, it's Rachel again. Welcome to part 2 of our passive income series on ChainSense. If you missed the first video about staking and lending, watch it after this. It's the foundation you'll build on. Now let's talk about the higher yield side of passive income. Yield farming. It's exciting, powerful, and yes, a little more complex. Yield farming means providing liquidity to decentralized exchanges or lending pools. You deposit 2 tokens, for example, ETH and USDC, into a pool. Traders use that pool to swap assets, and you earn a share of the fees. Many protocols also pay extra governance tokens as bonuses. That combination, fees plus incentives, creates the high returns people talk about. Well-known platforms like Uniswap v3, Curve Finance, and PancakeSwap are considered blue-chip options. Typical yields range from 10 to 30% annually. Some aggressive farms claim 50 or even 100, but those usually come with higher volatility or token inflation. To start safely, use stablecoin pairs such as USDC/UTST. They reduce exposure to price swings while still generating yield. Over time, you can experiment with ETH/BTC or multi-chain pools once you understand the risks. Let's discuss those risks. The first is impermanent loss. When token prices move differently, your share of the pool changes and may be worth less when you withdraw. The second is smart contract risk. A bug or exploit can drain funds. And finally, plain old market volatility. Crypto moves fast, so paper profits can vanish overnight. That's why farming requires attention and discipline. You'll need to monitor pools, claim rewards, compound them, and rebalance into safer assets regularly. Think of it like managing a digital business that earns while you sleep. Here's a simple example. You invest $1,000. $400 goes to staking for steady growth, $300 to lending for liquidity, and $300 to yield farming for higher potential returns. On average, that mix can produce 10 to 15% annually, with risks spread across several layers. The secret is balance. Stake for reliability, lend for liquidity, farm for growth. That trio forms a self-sustaining system that compounds automatically. Looking ahead to 2026, we'll see restaking protocols mature, tokenized real-world assets enter DeFi, and AI-driven optimizers that shift capital for the best yields. Passive income is becoming more intelligent and more automated every month. If you want complete portfolio examples, calculators, and weekly updates, check the complete 15-minute version on YouTube. Search ChainSense. And remember, patience always beats hype. Earn consistently, protect your capital, and let time do the heavy lifting. Thanks for watching. I'm Rachel, and this is ChainSense, helping you build smarter, not riskier. Educational content only, not financial advice.